Hey everybody, Ennis Whiteacre Properties back with another interview. Alex Ragnarsson is here with me, and Axel is someone that I've been looking and following for a while because I'm just impressed with the quality of what he's putting out there.
I really like the idea of you do the work once and you get paid forever, right? Honestly, I really do think it all comes down to being able to find good deals when you're starting out. I think everything else is noise. One of the phrases that I think I hate the most is if you have a good deal, the money will find you, and I think that's the most stupid phrase ever.
Honestly, I really have been impressed with how professional you've been with emails that you send out, with your presentations, and selfishly, I'm like, I need to know how this is done on the multifamily scale. I'm doing flips, I'm doing wholesales.
Yeah.
Like, why move into multifamily?
You know, there's a couple things that really sparked it. So one, I really like the idea of you do the work once and you get paid forever, right? Which is multifamily. That was something that really and that clicked very quick for me. I did a couple of flips. A couple of them I broke even. Third one I got absolutely hosed on. And what I realized through this process was I'm not a construction guy. I'm not good at managing construction. That's not my strong suit. I don't excel at that. And frankly, it's a massive deficiency of mine. And I was like, it's just a lot easier to buy a multifamily property where you turn a unit over for, at the time it was, 10, 12K now a little, more than that. But there's not a lot that can go sideways there, right? We're not changing floor plans. We're not doing massive upgrades. It's just throwing flooring down, maybe a new kitchen, new bathroom.
I know people struggle with that, but just curious how you managed to then jump into those bigger projects. Because capital, obviously you need more, right?
Yep.
Down payments, but then bank relations, and it's a different ballgame.
Yeah, that was really intimidating. But what was actually ironic about the whole thing was it was way easier for me to get financing on a 6-unit property, something that was 5+ than something that was 2 to 4 units. Because, the only option for that is a commercial mortgage with a local lender, right? There was no world in which I could get a 30-year fixed rate loan. That's the benefit of buying 2 to 4 unit properties, right? You get that favorable debt. But, I couldn't get that debt anyways. And I was financing these small deals with these commercial mortgages. So I was like, might as well just do slightly bigger ones. And same thing. Commercial lenders, obviously, they're still concerned with you as a borrower, right? They want to make sure you have a decent credit score and, you don't have a foreclosure or you didn't go bankrupt, the big stuff. But it was still pretty easy to convince small local lenders throughout New Hampshire that this deal made a lot of sense because I'm buying it at this price. I have a good story around finding it, right? I sent a lot of direct mail, did a lot of cold calling. I'm buying this 6-unit for $400K and it's worth $550, $575. The day I close, I could go turn around and sell it.
The equity.
So hey, your 75% LTV loan's actually really only 60% LTV or 58 or whatever it is because the value is much higher at closing. And to source the down payment, right, to bring the money to closing, people think it's risky, and in a way it is if you're not buying really meaty deals. But I was just doing a ton of second mortgage financing with private lenders. So if I needed $150K to close, hypothetically, I'd go to someone that I knew. Went to every RIA event, messaged everyone I knew with money, did the whole thing to try and find all of the people that could help. And I'd say, hey, let's put together a second mortgage here. I'll pay you 12%, get you a point when we pay it off, throw a year term on it. And there was the stakes were high, but at the time too, I was, naive. I didn't really know better, but I knew I was getting really, really meaty deals. And I also understood the commercial real estate game at an really early too, where it was, the rents at closing are $5K. We can get them to $7,500 AK. There's a translation down to the bottom line from an NOI standpoint. We throw a cap rate on that, and there's going to be a stabilized buyer that wants to pay much more than what I have into it. I was very comfortable with that.
If you're prepared and you got everything planned out, and like you said, you had partners there, but also went out and got a second, third opinion, you got to do your due diligence, right? Because you're still responsible to, even if it's an equity partner, you want to make sure they make money, right? So they can come back, do more and more. But really quick, because there's people probably that are watching this and don't know the difference between debt and equity. What's the difference there? Yeah,
so debt is capital that's provided where there is collateral, right? Yeah. It's collateralized by something, right? In the vast majority of situations in real estate, it's by the property. So you have, you go to the registry of deeds, you file a lien against the deed, and you actually have recourse if the borrower doesn't pay, right? If they don't make their interest payments, you can go file for foreclosure and, take over the property, right? And then you have an asset, you have collateral. Equity, on the other hand, the very simplified explanation of it is it's the down payment, right? It's the capital you're bringing in addition to the debt in order to buy the deal. Yeah. And that's the riskiest capital to invest. It's at the bottom of the capital stack. You got the debt above it. Money flows down. Debt gets paid first. Then whatever's left goes to the equity, right? One of the phrases that I think I hate the most is if you have a good deal, the money will find you. And I think that's the most stupid phrase ever. The asterisk is if you have a good deal, somebody who either knows the people with money but is also in real estate will find you, right? But you're going to give up a chunk of the deal to that person. But if you think that you're going to find a good deal and your uncle who is an orthodontist is going to write you a check, that's not going to happen because he doesn't know. He doesn't know how to identify a good deal. Exactly. You're telling him that, but he doesn't know that, right? Yeah. So it all starts with, trusting the individual implicitly, because the whole other piece of this too is the deal can go sideways, but there's also a percentage of folks that are just fraudulent.
Do you have to sell the property?
It usually depends on the documents that govern the deal. I mean, there's a lot of, for example, funds or syndications that are just permanent holds, right? And that's spelled out in the PPM, right? That's the legal document that governs the deal. And if you're investing in that deal, you got to look at that and buy into whatever the hold period is, because the reality is if you're an investor in these deals, it's illiquid. You can't just wake up on a Monday and sell your shares, right? There's it's very, very challenging to do that. So in the deals we do, we run our numbers over like a 5-year period of time and say, hey, if we sell in 5 years based on our projections, this is what the returns will look like. But we set the expectation to say, hey, if we hold this, and it's year 4, year 5, whatever it is, and the market's not in a good spot, or there's not, we don't feel it makes sense to sell, we have the right to hold it a little bit longer. So it's usually conversational in that respect. So I think you have to align the investors in the deal with what you're hoping to do with it.
When you have these limited partners, how is the bank looking at that equity that you're raising?
Banks are typically want to see sponsors with some level of skin in the game, usually at least 10 to 15% of the equity, right? So if you need $1 million to close, they want to see the sponsor with 100 grand, 150 grand, something around that. That's kind of a very broad rule of thumb. The other thing that they're going to look for is they want to make sure that no LP has more than 20% ownership of the deal, because then you get into the beneficial ownership stuff. And they, that's typically where they're going to trigger, we need that person signing on the loan, guaranteeing the loan. So you have to structure your documents in such a way that alleviate the bank's concern. Usually the way around that is just by raising money from more individuals at lower dollar amounts. So if you're raising $1 million, it's usually a little easier to do. You have 100 grand and you got, 9 other investors at 100 grand each or something along those lines, versus one, big investor at 500 and then some smaller investors, because that large investor is probably going to have more than 20%. You're probably going to have to navigate some kind of a conversation with the bank. And the banks are always going to look at the operating agreement, right, to determine who has voting rights and who has management control. So they're going to look for that language, right? So it's, they want to see that you are the manager, the sole decision maker. They don't want to see somebody else that has decision-making input that isn't guaranteeing or signing on the loan. So it's kind of a blend of all of those things. And I think it really depends on the bank. But those are kind of before we get into, sign a term sheet with any bank, we just assume that they're going to have those requirements. And then we try and navigate the little stuff, kind of throughout.
Good. As far as masterminds, books, mentors, what has made an impact?
So I'm a big pay for education guy. I'm not opposed to doing that at all. And the reason being I didn't forever and just stumbled along and made a ton of extraordinarily expensive mistakes. And then I started paying for it. I started making less mistakes. Funny how that works. So there was one, very expensive group that I joined that I'm no longer a part of because it was so expensive. And I feel like I got what I needed out of it, called Raise Masters, which was a capital raising mastermind. Literally the only purpose of this group is build a funnel of investors, monetize them, nurture them, educate them. And joined that a couple years ago as I was trying to more effectively enter that world. But now where I spend most of my time, money, energy trying to learn is on the business ownership side, because it's an entirely different thing to go from being a deal junkie to a business owner. It's just total opposite ends of the table, right? Something that was really helpful for me was this course by Cameron Herold. It's called Invest in Your Leaders. A great book that I love is The 4 Disciplines of Execution. That was really good. Leading, lagging measures, right? Being the fundamental thesis of that book. And that tactically allowed us to start setting goals around the stuff that's on the front lines, right? So I have my own KPIs as the guy who's responsible for raising the money. How many emails am I sending to the list? How many introductory investor calls am I having? How many podcasts am I producing and releasing? And those are the 3 that drive all those results. My acquisitions guy, it's just all offers. How many offers did we make this month? We have a target. We want to get to that target. We know that if we get to that target, we'll do deals, and it's very clear, as I'm sure you're aware of, obviously being in that game. And then that's really helpful from an asset management standpoint too. What's our renewal rate? How quickly are we responding to maintenance requests? How many showings are we getting in that first 7 days when we lease an apartment, right? These are all numbers that we can track that have a direct measurable, impact on a property's NOI. With that being said, there's a guy on Twitter. His name's Peter Lohman. He's someone I've known for years. He's out in Ohio. He runs a property management company that manages, single family to small multifamily. So really 1 to 20, 25 unit properties, which is a size of, in terms of a management portfolio focus that requires a ton of systems, which is why we've learned a lot from him, because he's been forced to systematize the business. Folks that manage a lot of single families, you got to be very systems oriented. So he sells, he does consulting calls, but he also sells a property management business in a box, as he calls it. It's basically all of his systems processes, but back end, all of that stuff. And it's just like, here, start on level 5, right? Instead of starting from scratch.
That's awesome.
So he's someone that we've learned a lot from as it relates to building the back end framework of the management company. And then we were all, I just listen to a million podcasts a week on this stuff, right? So I'm pretty dialed in on, this is what we got to focus on. But in terms of getting it off the ground, I think that's a great head start.
People that are starting out, because obviously you were there a few years back, and what can make a difference, and what do you see as the one thing that can really make an impact in jumping into real estate investing?
Honestly, I really do think it all comes down to being able to find good deals when you're starting out. I think everything else is noise. Like, all of the other stuff doesn't really matter unless it's helping you find good deals. So we got to break down the steps of doing that. You need to understand what a good deal even looks like, right? So that's like the education part. Do some underwriting. Whether you're looking at single family, small multi, whatever it is, you got to be able to run the comps. You got to be able to project your renovation. You got to be able to figure out what it's going to be worth when you're done and back into what you can pay. Step 2, now that you can identify a good deal, is, and part of that as well, I should have mentioned, is really becoming familiar with the market that you're looking to do deals in. Street by street level knowledge. Talk to all the brokers, all the PMs, all the other investors that do deals there. Just try and learn as much as you possibly can. And then it's about, how do we actually source good deals? Because they're not sent to people by agents. They're not online. That's just straight up not going to get it done. So focus all of your time and energy on figuring out how to find great deals. And once you find great deals, then the sky's the limit, because then it makes it a lot easier to raise the money, because you can do more deals, because you can you can sell it, because you can bring it to the partners, you can get your name on more deals, you get more stuff on your, scheduled real estate owned, and everything just gets a lot easier from there.
So Axel, how can people reach out to you?
So website is alignedrep.com, short for Aligned Real Estate Partners. My email is axel@alignedrep.com. Multifamily Wealth Podcast is the podcast on there a couple episodes a week.
Yeah.
And then we do have a course helping people find off-market deals, right? Which ties into what I was just talking about. Multifamilywealtheducation.com/off-market, one word. Everything that we do in our business, 5% of gross sales is donated to our charitable arm, which is Aligned to Giving, and we donate that to individuals and organizations that combat homelessness.
Awesome, man. That's awesome. Let's wrap it up here. Guys, I hope you find value in this. We're heading out to the Meetup event, so if you guys haven't joined us at the Meetup events, please do that. We'll put a link below. We have them once a month with guest speakers like Axel. And like, share, subscribe, comment below. I want to hear what you guys are taking away from these interviews, and if they are helping you and your business. Thanks, man. Appreciate it.
Absolutely. No, this was great. Yeah.
Thank you.